Okay, good morning, everyone. I'm Jonathan Bricker, and I'm the chairman of the Arkansas District Export Council, and I want to welcome you guys to the third session of the Export Finance Series. Today's topic is trade credit insurance, and today's webinar is only possible by the support that the DEC has received from the AEDC and Arkansas Manufacturing Solutions. I want to say thank you to both organizations for partnering with us. I really appreciate you all joining us today. For those that aren't quite sure who the DEC is or what we do, we're a private nonprofit organization that brings together experienced international business people with potential exporters. Each DEC member has been appointed by the U.S. Secretary of Commerce for their real-world expertise in international trade. Now, having said that, I don't know all the answers, but we can introduce you to people that do. So basically what we are is a community of connections within the exporting world. My hope for the day is that you walk away from this webinar with a little bit more confidence in your exporting abilities. And if you have any questions, feel free to put those in the chat. And if you don't feel comfortable asking it here, I invite you to reach out to us on our website at exportarkansas.org, and we'll reach out to you. We want to be your strategic partner to help you grow your exports, which helps grow your bottom line. All right, this morning, I'd like to introduce everyone to your moderator. His name is Rudy Ortiz. Rudy has recently retired from the Arkansas Economic Development Commission and is the previous chairman of the DEC. Today, he is the owner of Strategic Business Services, LLC, where he assists companies in a wide variety of international and exporting needs. He is a certified global business professional, as well as a U.S. Department of Commerce certified export and trade counselor. So for these reasons, he is the DEC's education chair. Rudy, thanks so much for spearheading this webinar. And with that, I'll turn it over to you.
Thank you very much, Jonathan. I appreciate that. You know, the majority of the webinars and other presentations that we make at the DEC are really what one might consider risk mitigation. That is, how to do the separate functions of exporting and doing them safely in such a manner that you'll have good profits and that there'll be very few things that go wrong. Just as an example, looking at different countries and where the opportunities are and the things that you have to watch out and the things that you have to consider before you enter specific markets. This particular series of classes, of course, is finance based, and it's showing you tools that are out there that you can utilize to try to mitigate your downside financially. And today's class is going to be on trade credit. And we have with us today Mr. Hoots. He is a trade credit and political risk program broker, which helps companies to better manage and execute their international and domestic transactions. Currently, he's a board member of the Maine District Export Council, and recently he was named the Service Provider of the Year by the Maine International Trade Center. His background covers international trade, both commercial and investment banking and management consulting. And he has a company called NaviTrade. Before he started NaviTrade, he has really kind of lived in several different parts of the country and the world, and went to the prestigious Thunderbird School in Arizona. For those of you who are interested in international business, Thunderbird is considered one of the very best programs in the country. So Mr. Hoots comes to us very well equipped to be able to teach us about the different things to consider in terms of trade credit programs. And with that, Mr. Brent, if you would take it away, would appreciate it.
So Rudy, thank you so much. And thank you, Jonathan. Let me get my screen sharing going here. So great. Well, good morning, everybody. It's nice to be here and looking forward to talking to you. We're going to focus in today on export credit insurance. And well, we're going to talk a little bit about export credit insurance. What we're really going to do today is I'm going to walk you through a story about a client of mine from actually many years ago. And the point of the story is that it was a smallish, medium to smaller sized company that on their own decided that they were going to find growth through exports. They had done very little exporting before, but this became a priority. So on their own, they went down this path and they ended up in a bit of a quagmire and lots of issues and things were happening and everybody was very frustrated. So we're going to focus on that first and then talk about how an export credit insurance program kind of fixed everything. So it's a bit dramatic. And the point of today is that hopefully you'll connect and you'll have a couple of aha moments and you'll say, okay, I got it. I see what the strategic value of export credit insurance and the Export-Import Bank of the United States, for example, might be as a partner. So with that, let's go. I'll jump into the story. So company frustrated, having issues. I was invited to stop by and visit with the company and to find out about what was going on. And they were looking for solutions and strategies to do better. Went to the company and was ushered into a conference room. Are you all seeing my screen? Is that visual? Does everybody see it?
Yes.
Okay, great. Thanks. So in this conference room, it was really a terrific group of people. They were all seasoned professionals. It was exactly the right group to talk about their exports and the possibility of export credit insurance. So the head of sales for international, on the international side, credit manager, CFO, CEO, they were frustrated. And we decided that meeting should be about them talking about where they were, the things that they've progressed through and what happened to them. So the first person to start in the meeting was the head of international sales. And she was a seasoned pro, very good at what she put at the international piece. And she said, look, you hired me to find overseas opportunities for the company. And we've done that. And in particular, Brazil should be a really good market for us. And we think our best market penetration strategy for Brazil, and of course, Brazil is huge. We think the right way to penetrate that market is through a partnership in Brazil. And we have found a distributor that we think should be great. So the idea of the distributor she talked about and who they were, and she said, look, they believe they can ramp this business up to $100,000 a month. Okay, so this is kind of a home run for the company. It's a really quite a bit of business and a really good success for them. And she said, our partner, this Brazilian distributor, they're looking for 90-day terms from us to be doing this business. So right there we have the beginning of some questions. So this is a company new to exporting. They're new to Brazil, and this is a new relationship with a distributor in Brazil. So it sounds great, $100,000 a month, which would be $1.2 million for the year, right? So this is really good business, but a lot of issues, right? And when we say $100,000 a month and 90-day terms, what does this become? What does that mean? So let's walk through it. We ship on day 1, 30 days later, we ship again, 30 days later, we ship again. We're at day 60, we have 3 shipments outstanding. So we've ramped it up to $300,000 outstanding. So, and then 30 days later, we finally hit 90 days and the distributor would make a payment and we would ship, so forth and so on. Every 30 days, they make a payment, we ship. So in theory, $100,000 a month, 90-day terms means we're going to ramp it up to, on average, $300,000 outstanding. So that's a lot for my clients. That's significant for 2 reasons. It's a new relationship, a new market. So we're concerned about risk issues. And also, not only are we concerned about risk, but for us as a company to have that amount of money outstanding for an extended period of time, that's a drain on our cash flow for us as a company. So we have cash flow issues. So we stop and look at that and we say, well, the distributor is looking for 90-day terms. And let's talk about distributors for a moment. Why? Why do distributors ask for terms? I think a part of us, we feel like, look, we have a great product. And this is a really good price for you. Just pay us, okay? And we'll ship it, right? But not so simple, not so easy. In fact, this Brazilian distributor, their perspective here was that if we place the order, it'll take 2, 3, 4 weeks to get the product to Brazil. And as a distributor, it'll take us 2, 3, 4 weeks to get it into the market. And then 2, 3, 4 weeks to get paid. So the Brazilian distributor's perspective on this product cycle in their market was definitely 60 days, sometimes pushing out to 90. So that becomes an issue for them. And of course, it's an issue for us. We have the risk and the cash flow issues. Three things to talk about with distributors on this chart. First of all, your best opportunities a lot of times are in developing markets. We'll find great opportunities there, but small and medium-sized distributors especially tend to be thinly capitalized in these markets. And that means they don't have necessarily a lot of cash to work with, and they don't want to use it on your product, okay? If in a perfect world, a distributor really wants to sell on consignment, they want you to send the product to them, they want to sell it and then pay you. So that's really what distributors are trying to achieve. We have clients that were dealing with Costco Spain recently. You deal with Costco Spain, you will give them what they need to achieve that. So Costco does not invest huge amounts of capital in companies' product lines. They're effectively selling on consignment almost. So thinly capitalized. Two other issues. So distributors in these emerging markets especially tend to be in markets that have high interest rates and a lack of financial liquidity. So what this means is if we insist that our overseas distributor pay us up front for the product, that means that distributor has to finance that business. And it's not necessarily true that a distributor in Brazil perhaps does not so easily walk across the street to a bank to arrange financing, okay? And that's about a market lacking financial liquidity. There's not a lot of solutions there for financing, lacking financial liquidity. Also high interest rates. So if we insist that the Brazilian distributor finance this, it's going to be at relatively considerably higher interest rates typically than the United States. So these are the issues that distributors and overseas buyers are confronted with. It's important to understand that. Back to our conversation. So again, the head of international sales has done a great job. They found a great market and a great distributor. It turns out the distributor is good, and we find that out. The next person to speak at the table was the credit manager. And the credit manager said, this sounds great. We're really excited about the international. But my job as the credit manager is to help the company reasonably and prudently manage risk issues. So we have two things going on here. We're new to exporting, and we're new to Brazil. You know, we don't know what does it mean to be, shipping product to Brazil, and we're also concerned about, pardon me, the creditworthiness of this Brazilian buyer, right? So the credit managers, this is his focus. He actually did research on the Brazilian distributor, and he said, look, we like this distributor. We think they're pretty strong and they know what they're doing. We think they could be a good partner for us, but we are all about best practices, okay? And within our industry and in this situation, best practices really suggests that we do net 30-day terms and a $100,000 credit limit, not net 90-day terms and a $300,000 credit limit, okay? So this is the perspective, the best practices perspective of the credit manager, right? Immediately speaking up then was the CFO at the table. And again, she was a seasoned CFO, very good at her job. And she had the same attitude. It was like, the international sounds great, but if you're telling me that we're going to be opening up new markets overseas and selling on open account terms to a growing list of buyers, then that means we're going to have a growing mountain eventually of foreign receivables. We're going to have a lot of outstanding payments that we expect to come in from overseas buyers. And she said, that's a cash flow burden for us. And in fact, if we get a lot of traction, we might not be able to achieve this, this might shut us down, those receivables outstanding. And she said, I've talked to our bank about it, and they are not interested in financing our foreign receivables. So I'll stop and ask the audience right now, is that true? Do US banks not really want to finance foreign receivables? In fact, that's very true. Domestic banks, US banks, typically to not fund foreign receivables unless they are, yes, backed by EXIM Bank or another credit insurance mechanism. But at this point in the story, the CFO was not aware of that as a strategy, and her bank wasn't either, which is very typical for a lot of banks in the United States. So she would say, this is a cash flow issue. We have a problem here. So the next person to speak at the table was the CEO. And the CEO, as you can imagine, said, well, we are all about growth. So we are really looking to grow, right? And he said, look, I really appreciate, great job, head of international sales, super job. And our credit manager, wow, you have helped us dodge some bullets over the years. So we really appreciate your focus on best practices. And I've talked to our CFO, and this is a real issue, the cash flow, right? So we talked about all of this for a few minutes, and the final position of the CEO was to, well, let's go with best practices, net 30 and $100,000 credit limit. Let's go down this path and try to work together and try to make this work, okay? So what happens when a company is on its own and they are going with best practices in this scenario, for example? So let's take it one step at a time. On day one, we ship 100,000, right? 30 days later, the Brazilian distributor calls and says, we're ready for more product. The pipeline's ready, the market's ready. The credit manager jumps on the call and says, no, we're really gonna go with net 30 and $100,000 credit limit, which means we shipped you 100,000, it's due. The Brazilian distributor says, we don't have the money yet. We've not been paid for it. So that's the end of that conversation. So then another 30 days goes by, right? And we're at 60. The Brazilian distributor calls and says, we are really ready for product. We've done our job. The pipeline's ready. We want more product. And credit manager jumps on the line again and says, look, we're really serious about net 30 and 100,000. At this point, you're 30 days past due. And the Brazilian distributor again says, we have not been paid for the product. We do not have the cash. We can't make payment. It's the end of that phone call, right? So then during the next 30 days, as we're approaching 90 days, the credit manager has his team now sending communications to what is a problem buyer, somebody who's way past due. So the Brazilian distributor, not happy. They're not getting enough product. They're not happy about the irritating phone calls from the credit manager. The credit manager is not happy. They've said net 30 and 100,000. Now we have a buyer that now is 60 days past due on 100,000. So the credit manager now sees the Brazilian distributor as a problem, and it's reflected in his aging. A receivable aging is super important to companies for internal management reasons, and your board of directors cares about it, your bank cares about it, your investors care about it. It's not a small thing. Receivable agings need to be managed really well. So the credit manager is not happy. The CFO, again, she was very clear. This $100,000 receivable that's outstanding, this is a cash flow burden, it's not bankable. The CFO is not happy. And what about the head of international sales? And this situation, we see it all the time. When we have a problem buyer in an overseas market, everybody kind of goes back to, hey, whose relationship is this, right? And a lot of times we're pulling the head of international sales into this and try to fix it. So instead of the head of international sales being out there developing new markets, and by the way, who wants it at this point? Everybody's frustrated. This is not very good for them right now. So the VP of international sales is dragged into this, so not happy about it. What happens here? When we have net 30 and 100,000, we're shipping in this scenario because they needed 90. We're only shipping every 90 days because that's how it's going to work for the Brazilian distributor when they get paid. So every 90 days, shipments turns into $400,000 for the year instead of $1.2 million. So $100,000 a month has the potential to be $1.2 million. We've constrained this business now to exist at 400,000. Okay, a trickle of what we could be doing. Also, the risk we have, we're holding that $100,000 risk at all times. Okay, so this is not productive or happy. It's a frustrating situation for everybody. So we talked about it and we said, well, let's put in place an export credit insurance program. Let's talk to EXIM Bank. And we did that. We applied and went to EXIM Bank, which is actually a fairly quick process. We can get that done sometimes in a couple of weeks. So that's very possible. So we did that. We went to EXIM Bank and we said, this company is all about international. They need your support. And we were very clear with EXIM Bank. We're starting right off the bat with this thing in Brazil. And we need a $300,000 credit limit and net 90-day terms. So EXIM Bank pondered that, came back to us. They gave our client the program they needed, and they agreed to supporting this Brazilian business at a $300,000 credit limit and net 90-day terms. So it's like fantastic. I'm going to pause for just a minute. I'm going to let everybody think about why you should be frustrated with me right now. And somebody in the audience who's saying, wait a minute. Let me have a drink real quick.
Brent, would you like me to launch the poll sometime?
Oh, sure.
Okay.
Yeah. Thank
Would
you,
you like
Heidi.
to do that now?
Sure, absolutely.
Okay.
And I can keep talking if people can look at the poll.
Okay.
So, but here, everybody in the audience, you should think in terms of, well, wait a minute, Brent, you said that this company, the credit manager, were all about best practices, and best practices for this industry really was net 30-day terms and $100,000 credit limit. Okay. So your question to me should be, what the heck? How does EXIM Bank just randomly go to 300,000 and net 90? And your real question, when you think about it, should be, well, doesn't EXIM Bank have to also exist and operate within best practice guidelines for that industry? And the answer is no, EXIM Bank doesn't. EXIM Bank needs to apply best practices for who they are within their industry. So EXIM Bank is a global underwriter, 24/7, 365. This is what they do with a huge team of people in Washington, and they are super well connected to banks, lawyers, credit insurance groups around the world, and they have lots of knowledge and information. So EXIM Bank exists at a much higher level than my clients. So, and if you can see my hands, this is it. This is the value proposition of EXIM Bank as your partner. My clients typically should stay with best practices, and they should be doing net 30-day terms here and $100,000 credit limit. But the question really is, how can my client get to where they want to be? And the answer is a partnership with EXIM Bank.
Okay. Hey, Brent,
Yes.
hang on just a second.
Yeah.
Let's give the rest of the people on the call a minute to finish out the survey questions, because I want to make sure
Sure.
that they don't miss out on anything that you say, because obviously this is critically important.
Sure.
So if we can just give them another 30
Absolutely.
seconds to finish out the
And I will
questions, that would be
adjust, the sun is coming in. I'm going to adjust my blind real quick.
Sure thing.
I'll be right back. Pardon me.
All right.
Is that better? Oh, that's better.
all righty. Well, let's just go ahead and move forward then.
So just to reiterate, the point here that I was making it in the story here is that my client was correct to stay at net 30 and $100,000 credit limit. But the question is, how can my client get to where they want to be to give the distributor what the distributor wants, to open up the floodgates and do a ton of business? And that is the value of the partnership with EXIM Bank and credit insurance. EXIM Bank as your partner can take you to where you want to be, but a place where you shouldn't be on your own. This is how we view that. So, so we walk through that situation, and so we have EXIM Bank support. Now let's together walk through the business step by step. Now that we have EXIM Bank as our partner. Oh, you know what? I just. There we go. So with EXIM Bank as our partner, the business totally changes. Now on day one, we ship $100,000. 30 days later, we ship another $100,000. 30 days later, we ship another $100,000. So we've ramped this up to 300,000 outstanding, right? So the Brazilian distributor's happy. They're getting the product into the pipeline the way they want it. But what about the credit manager? So before he was adamant about, 100,000 is plenty, that's generous. Well, now we have 300,000 outstanding. With EXIM Bank as our partner, the credit manager says, okay, we're good. EXIM Bank is my partner. EXIM Bank is covering our risk at 90%. This is what a credit insurance mechanism does. EXIM Bank is our partner, takes on 90, probably 95%, but 90% definitely of the risk. So the credit manager says, EXIM Bank's my partner, 300,000 outstanding, but they're taking 90%. I only have $30,000 risk here in a non-payment situation. So the credit manager says, we're good, we can do this. And the credit manager now notes that when we hit 90 days, the Brazilian distributor pays, because that's when the cash is there and available, so forth and so on. The Brazilian distributor now becomes a good paying customer, and the credit manager's aging is good. So the credit manager's happy. The CFO, before we had $100,000 outstanding and she was frustrated, it's not bankable. Now we have 300,000 outstanding. And her position is, well, I've talked to our bank about this and they understand EXIM Bank as our partner. Because of that, they're willing to put these foreign receivables into our borrowing base. So the CFO says, I'm good. We can do this all day long. We can ramp this. This is scalable. This is scalable. We can do it, okay? So the CFO is happy. What about the head of international sales? So the VP of international sales, this is running smoothly. Brazil's good. The VP of international sales is out there looking for the next Brazil, the next opportunity, and everybody's excited about it because it's working. In this scenario, EXIM Bank is their partner. They have the potential to do $1.2 million for the year. On their own, they were going to be constrained to 400,000, okay? And remember, on their own, they were holding that risk of 100,000. That was theirs. Now with EXIM Bank as their partner, even though they have 300,000 outstanding, only 10% of that stays with the company. So the company's risk is only 30,000. So very dramatic. These issues we see day in and day out all the time. So when we stop now and think about the story, and I think this is really important, what is the story about? To me, this is a story about a company that said, we're looking for growth and we're going to find that in overseas markets. They pursue that, and on that journey, they bump into financing and risk issues. But those are secondary to the story. The story is about growth and marketing issues, new markets, new relationships, and how we manage that growth and marketing. So at the end of the day, I really view export credit insurance and EXIM Bank programs as an amazing tool for growth and marketing purposes. And a couple of interesting points. Still terribly underutilized, this strategy in the United States, okay? Highly utilized in Europe. So we're really working on spreading the word and getting the message out there, and it's a growth opportunity for everybody. I'm just going to very briefly mention these programs tend to be pretty fast to get, cost effective. Think in terms of about 0.5% usually. And some people might say, well, 0.5%, that's something. In this story, would my client pay 0.5% to move their business from 400,000 to $1.2 million? In a heartbeat, right? So I never have clients concerned about pricing. In fact, overall, the pricing here is a pittance of what the value is. Going through this, it's EXIM Bank is especially great. There's no upfront payment, it's pay as you go, and no minimum for the year. So this becomes the low-hanging fruit. You can get it, no upfront payment, just use it as you need it. Very much something companies can do and do proactively to get on top of these issues. So I'm going to leave you with those primary thoughts that I see companies all the time that say, well, we need to find opportunities. We need to understand the nuts and bolts of exporting. And then they think they're done. But there's a third leg to this table, and that's execution. And these are all the issues that go with your overseas buyers. And some of these are kind of subtle and nuanced and require being engaged with your overseas partner, understanding their situation. So that's it. This is the first step. The export credit insurance details. If you find this exciting, then my clients tend to say, oh my gosh, this is great. Wait a minute, we got to find out more about this. So for today, I hope you connect with this strategically, and looking forward to further discussions. And Rudy, Jonathan, thanks so much for inviting me.
Very good. Bert, thank you so much. One of the things that I want to perhaps make clear, just in case people don't have the experience with countries like Brazil, while interest rates are definitely going up in the United States, historically, if you're a business, 6-7% was, I think, pretty typical of interest rates. Historically, Brazil has been at 30-35% at the same time that we were at 6 and 7. In other words, 5 times the normal interest rate. And this is, this has been going on for a really, really long time. Has nothing to do with COVID, has nothing to do with what's going on with the economy right now. This is historically what Brazil charges their consumers and the businesses is 30 to 35%. And so you can see where if you're a business in Brazil and you're being asked to pay upfront and you're having to go to your Brazilian bank and pay 35%, I mean, that could eat your, that could eat up your entire profit margin, right? And so of course, that's another reason that they're very, very hesitant at paying you upfront, and would prefer to get the money in hand and then pay you as quickly as possible. So those are some of the things that as a exporter, you have to take a look at, is the country that you're doing business with or are thinking of doing business with. What is the situation there from a finance perspective?
Exactly.
And perhaps can you, through the EXIM bank and maybe through the SBA, provide some sort of advantage to your, to your foreign buyer that others might not be able to do so, because we have the blessing of living here in the United States, and our economy has historically been much more sound than many other countries, and so we definitely have advantages. And EXIM and SBA are a couple of different ways that you can mitigate the risk, allow you to grow your exports, and at the same time provide a benefit to foreign buyers.
Good point, Rudy. Excellent point.
Yep. And I want to go ahead and go to, let me see here. So Eddie Sumer, Eddie, I met him at the conference, at the NADEC conference in DC, I guess last year. Great guy. And he says, I work with Brent and he's the best broker and partner. And so I appreciate that.
Thank you, Eddie.
Ms. Heidi, do we have any questions that you're aware of? Oh, yeah. The question is from Robert Lynn. It wanted to know what the EXIM interest rate or fees were. And could you speak to that, Brent?
Sure. So for export credit insurance, so most of my clients have what is called the Small Business Export Credit Insurance Program. And if you get, and it's usually a multi-buyer program. So the concept is we go to EXIM Bank and we say, hey, we're an exporter and we might be in a bunch of different markets. So EXIM Bank gives you this program that's going to expand and accommodate new markets and new buyers. And they have basically a set pricing for different periods of time that that you invoice out. So typically for invoices that are from net 0 days out to net 60 days, the pricing from EXIM Bank is 0.55%. So not 1%, but at 0.5%, 0.55%. That gets you out to net 60. From 60 days out to 120 days, the pricing jumps up to, I want to say 0.90. So it's a bit of a jump there on a pricing, but out to 120 day terms is quite a bit. So, and there's tiered pricing based on the outstanding timing of your invoices and what is stated on the invoice. So again, typically most of my clients are net 60 and shorter, sometimes beyond, and you jump into the next pricing tier. Again, EXIM Bank does not require an upfront payment for the program. There are private sector underwriters. Let me comment on that briefly. For export credit insurance, there's EXIM Bank, which is a government program. We might have like 9 or 10 private sector underwriters. They're all great, and they all have different market niches that they upon which they focus. But typically, the private sector, when I talk to people, to be of interest to the private sector, you need to have a certain volume of business annually, where the fees aren't enough for the underwriting community in the private sector. That number typically is around 3 or 4 million minimum for the year. So if you're an exporter with less than 3 million in total export sales for the year, you're really talking about EXIM Bank as your solution. And good news, it's a great program. So that's not a sacrifice. It's very productive and a good thing. That's like just a quick comments there. I don't know, Rudy, did that answer your question?
Yeah, I think it does. And let's just say, just for rule of thumb, that let's call it 1% instead of 0.9%. Let's call it 1%, but 1% fee to be able to mitigate up to 95% of the risk. Wow. I mean, that's a no-brainer, right? Anyway, this is a fantastic tool to be able to increase your export sales and at the same time mitigate your risk. And as Brent so wonderfully showed the story that he portrayed, when you have CFOs and CEOs and credit managers and VPs of sales, each one of them have their own pain point, and it's not the same pain point. And so this addresses the pain point of everyone, and that's an absolute solution there. So once again, the District Export Council is here to be able to help you guys in any way that we can with information and mentoring. And Jonathan, why don't you go ahead and jump on and say whatever words of wisdom you want to provide to us?
Go ahead, Miss Heidi.
Yeah, there's one more question.
Oh, okay.
Chat. Look in the chat.
Oh, I see. Do private sector underwriters reinsure their foreign receivables coverage with EXIM? And I'll repeat that. Do private sector underwriters reinsure their foreign receivables coverage with EXIM?
So that's a great question. So there's a lot of reinsurance going on within this industry. That's a really good question, actually. On this, I'm not really sure about the answer to that. If EXIM Bank does reinsurance within the industry, I know they have partnerships and they do a lot of things with the private sector and other underwriters in overseas markets. Sometimes I don't have the exact answer there on that.
That would be a pretty good strategy, wouldn't it? Yeah, on the part of the private insurance, is to reinsure their own deal, their own downside with the EXIM. I actually do not know the answer to that, but I'm going to look into that because that's a pretty good strategy.
There's also a question in the chat.
Okay. You see, shouldn't the payment terms with the Brazilian distributor reflect the actual payment cycles, a minimum of 90 days, and more likely 120 days? It will take 1 to 3 weeks to process the order, 3 to 6 weeks shipment time and customs clearance. Very optimistic for Brazil. And that's before the distributor gets the goods in its warehouse. I mean, the bottom line is that, there's a pretty long lead time, irrespective of the ability of the Brazilian distributor to pay or not to pay.
Well, that's a good question. This story and kind of the narrative I'm giving here is several years old, actually. It's just such a great story. And it was a particular company many years ago. And this was kind of the, generally speaking, the numbers and what was going on at that point. So, but if I think the question is looking at the product cycle is how I look at it, from buying the product, getting it to the market, and then getting paid for it. That's ideally what a distributor wants to achieve. They want to be able to pay the U.S. supplier after they've been paid. So it needs to incorporate all of that. And I'm not sure what that timing might actually be. Quite a bit longer today in Brazil.
Yeah.
So,
Yeah, I mean, if your story is, let's say, previous to 3 years ago, we may have been talking about, the 60 days, maybe even 90 days now. My goodness, it could be significantly longer. But, I think at the end of the day, the problem remains the same. It's just exacerbated. Regardless of how long it takes, the credit manager wants to make sure that our downside is being protected as the CFO. Also, everybody wants their downside protected, and the fact that it's going to take X amount of time to get there and get distributed, I guess you could say they see it. That's not their problem. They shipped the product. They are out the money. And so they're trying to protect their downside regardless of what other dynamics are in play, and so I think nowadays, even more so, a product like the EXIM programs are an even more important part of your strategy, because stuff is taking so much longer than it used to. There's another one. What percent of interest is charged on 300,000? This would determine several factors.
So EXIM Bank, when you have, if you're talking about the short-term multi-buyer program with EXIM Bank, again, we get this program, we have it in place, and EXIM has pricing, tiered pricing, based on how long receivables or invoices are outstanding, or invoices are stated, the terms is what drives it. I'm sorry, Rudy, what was the question?
It says, what percent of interest is charged on 300,000? Let's start off with that.
Right, it's a flat invoice based. So if in the month of November, for example, you have $300,000 of shipments to an overseas buyer, then the next month, by the end of the next month, we would report that shipment to EXIM Bank and pay premium to EXIM Bank on that shipment. So it's pay as you go the next month. The pricing would be, on 90 for 90-day terms, in this scenario, it'd be around 90 basis points, so 0.9%. So I have to plug that into my computer real quick here. So 300,000. $2,700 would be 90 basis points. So that would be ballpark what you pay EXIM Bank the next month. So, and again, in this scenario, that is two things. Actually, Rudy, you made a really good point earlier to revisit the discussion of interest rates in an overseas market. So instead of the Brazilian distributor going to their bank and borrowing money to buy the product, which would be at an exorbitantly high interest rate, what we do is we sit at the table with the Brazilian distributor and we say, look, we're going to extend you 90-day terms, but that means we have to finance this with our bank, and our bank requires this EXIM Bank fee. If you look at the all-in internal yield on that as a loan, we have EXIM Bank's fee and what we pay our US bank, which is a low interest rate. So the effective yield on that is a loan. The point is, we say to our Brazilian partner, we're going to pass on or share these financing charges with you. And the Brazilian distributor says, let's see, that is a pittance of what we would pay here in Brazil. So good deal for everybody. So there's a really great argument for sharing those costs or passing those costs on to your overseas buyer. And it's a good deal for everybody.
Yeah, which of course will increase your margins even higher, right?
Yeah, right.
Yeah.
And it's going from 400,000 to 1 million too, where this EXIM Bank helps us open the floodgates and just do a ton more business sometimes. So,
Ms. Heidi, did you have something you wanted to tell us about the Survey Monkey that we're going to be putting out?
Sure, yes. I accidentally put in the wrong link there, but yes, there will be a survey that you can take to evaluate the webinar. The slides are also available. I just put the link to the slides in the chat. And I think there's a few more questions. I'm not sure if they've been
I'll
answered
take
yet
a
or
look
not.
at I'll take a look at that in a second. But I do urge everyone to go ahead and fill out the survey. You know, the only way that we're going to know whether we're doing a good job or whether we should have done things differently, or you know, how to improve our series of webinars that are intended to help you, is to hear back from you guys to tell us how you think we're doing and perhaps areas of improvement. So please do go ahead and respond to the survey if you can. Um, it says here one question by Robert Lynn: walk through the impact on the seller if the buyer defaults on the payment. Well, that's a great question. In other words, you know, the reason that you're doing this EXIM financing or credit insurance is because something could go wrong. So then the question is,
Sure.
okay, so something did go wrong. Now what?
Right. Two things. I will address that for sure, but I just crossed my mind. There was something I also wanted to address to everybody. You know, in our story, and sometimes clients want to do something, and we go to EXIM Bank or another underwriter, and we say, look, maybe we need a $300,000 credit limit and 90-day terms. On the day that we go to EXIM Bank and ask for that, and if EXIM Bank comes back to us and says, we're not doing it, we're not going to do that, that really begs the question for my client, why would they be doing it? Okay, because this is, you know, this is the US government, unlimited resources, and they're highly motivated to say yes. Their mandate from Congress is to say yes, to give programs and to underwrite. Their revenue stream for EXIM Bank comes from only underwriting, okay? So EXIM Bank is highly motivated. On the day that EXIM Bank says, no, this is great information for my client should be doing cash advance or letter of credit. That was the first thing. In the event that we have a problem with the buyer, this is another great value with EXIM Bank as your partner. So let's walk through it. Maybe this scenario, in this story, we shipped and we have these outstanding shipments to this buyer in Brazil, right? And all of a sudden they're past due. They're way past due. And now we're getting nervous. We're thinking, oh my gosh, do we have a non-payment situation? So the first thing we do is clients always talk to their broker. So we're on the same team. And we might also be talking to EXIM Bank. It's like, okay, we're nervous here. And one of the things that we do and brokers can do for you is we can send out what we call the scary letter. So if you think about an overseas buyer, they're 95% of them, they're terrific people, they're good people. Sometimes we get stuck between a rock and a hard place. So imagine an overseas buyer that just has cash flow problems and they can't pay somebody. So they say, this small company in Arkansas, we're not going to pay them, right? What are they going to do to us? We're in Brazil, we're not going to pay them. But then we do the scary letter, and my client in Arkansas sends the scary letter to the buyer in Brazil, which says, these outstanding invoices are past due. You should instruct the buyer to make payment, that you are protected by the US government, which has billions of resources and will pursue this to the ends of the earth, basically. So it's a letter to an overseas buyer that is saying, wait a minute, you thought you were dealing with a small company in Arkansas, you're not. And the first thing EXIM Bank will do is to spread the word. There's a thing called the burn union list, ways to put bad people on a list that become known globally. So there are all kinds of things we do to bring pressure to bear. And we've done that so many times. And lo and behold, you know, if you're saying, oh my gosh, it's not a small company in Arkansas, it's the US government, let's just pay them. We'll not pay somebody else. And I feel bad about that. On the other hand, all companies should have this program, then we wouldn't have that problem either. But so first and foremost is a scary letter, which avoids problems a lot of times. In the event that we really have a non-payment situation, kind of the quick story here is EXIM Bank gives you a window of time within which to file a claim. And it's from, that's a block, anywhere from 90 days past due out to 280 days past due. So as soon as you hit 90 days past due, you can file a claim, okay? But no later than 280 days past due. That's good. So, companies don't really necessarily want to be forced to file a claim, because when you do that, you're done with the buyer. You're kind of done, really, for the most part. But maybe there are things that are happening and you want to give them more time, and you're okay to do that. So there's a window of time within which to file a claim. There's a claims document that we complete, and a broker helps you do that. And then we send that to EXIM Bank. EXIM Bank demands that you have a reasonable transaction. So EXIM Bank requires it to be a US product, and their definition of that is at least a 50% US content. So before we get an EXIM Bank program, you need to have basically enough content, US content, to qualify for a program. So once you achieve that, then a few very reasonable things you have to keep track of. But at the end of the day, if you have a claim, you need to present to EXIM Bank a purchase order for the client that matches up with your commercial invoice and a bill of lading. So you need a document that says they wanted it, the document matching your commercial invoice that says this is what we gave them, and a document that shows it was exported and received. So, and those are all standard documents that my clients typically have, but as a broker, we want to be on top of that and make sure that that's correct. Sometimes these documents don't tie very well, technically, for a variety of reasons. We want to look at that and make sure that we have good documents. That's another value of the program. When we have EXIM Bank as our partner, we stop and we think about reasonable things. And what EXIM Bank wants us to do, we should probably already be doing that. So the whole thing is a bit of a wake-up call and helping companies to do better through a partnership with EXIM Bank. So did that answer the question? And claims payments are, if you provide the right documentation, within a month, EXIM Bank will turn that around.
Yeah. So kind of a follow-up to that is, what kind of information does EXIM need regarding the in-country importer or distributor in order to provide receivables coverage? So what sort of information do you need about the in-country importer or distributor?
Oh, so in this story, the Brazilian distributor?
Yeah, in this case, yeah.
Well, so as an underwriter, when we go to EXIM Bank, we're asking EXIM Bank.
No, my apologies, Brent. I left out the very last part. In order to provide the receivables coverage. So, what kind of information does EXIM need regarding the in-country import distributor in order to provide the receivables coverage, in order to write the coverage?
Sure. So there are a few different ways you can have coverage in an EXIM Bank program. Let me just focus on a special buyer credit limit. So if we have an EXIM Bank program, and let's say we have a pretty large request for coverage with a buyer, that we go to EXIM Bank with a very easy, short, pretty much a one-page application. And it says, hey, EXIM Bank, we have this program with you, and we would like coverage on this buyer in Brazil. And we want this dollar amount and these terms. By the way, our track record with them over the years looks like this, and they have performed reasonably well. And we would typically attach a credit report, which gets us there to $100,000 transactions and even 300,000. Now they've recently changed this. It turns out that if you are requesting, I'm pretty sure it's $500,000 or higher, that we need to present to EXIM Bank actual financial statements from the overseas buyer, which is completely reasonable on a $500,000 underwriting. That's big. So a company that warrants a $500,000 credit limit should be able to shoot you off their financial statements, no problem. So smaller transactions, a credit report typically. Larger transactions, we might need financial statements. And then we present that to EXIM Bank, and they underwrite. They determine the creditworthiness in the situation and whether or not they will approve all of it, some of it, or none of it. So.
Okay. All right. I
think
think
there's a few questions that were in the chat as opposed to the Q&A.
Okay, let me
There
see.
was one from Mr. Terrence and one from Miss Shirley.
I think those are all, I think they've all been answered.
Okay.
Yeah. All righty. Well, ladies and gentlemen, I think we're coming up on the time. If Ms. Heidi, if you will put up the slides that pertain, in just a second, put up the slides that pertain to everyone's contact information. Obviously, we're here to be able to help answer any questions that we can and that perhaps we didn't have time to cover. And so feel free to contact whoever you think is the appropriate person, or if you wish, you can contact me and I will point you to the appropriate person. And I think with that, we have Brent's contact information, mine as well, and Ms. Heidi, if you have a question for her. And once again, if you please would go ahead and answer the survey, we really would appreciate it. We're trying to improve our services to you, and the only way we can do that is to know that we need to improve something. These are also the next couple of programs that we have coming up. Next week is the final class in the four-part finance series that is managing currency risk. Once again, risk mitigation, right? But this is about using foreign currency, which can provide you a real advantage with your client, but there are risks involved, and here's a way to be able to mitigate that risk. And then on December the 7th, we're doing business in Canada. And so we'll hope that we can see you during those webinars as well. And I think, Jonathan, unless you have something else with that,
No,
I
I
think
just I appreciate, Rudy, you spearheading this webinar. Brent, thank you for the insight and the education that I got today.
Absolutely.
And I want to thank everyone that participated. The questions were amazing, and I love the interaction.
right.
So, I mean, kudos to you guys as
Yeah.
well. So,
Yeah, great questions. Absolutely great questions. Yeah, pertinent and insightful. No doubt about that. And that's one of the things that makes these webinars so useful, especially when they're interactive and people are asking questions, because invariably, if you don't know X, there's probably 100 other people that don't know X either. And so keep the questions coming. No question about that.